Good evening. Welcome to our UC Irvine Alumni Association Homebuyer Workshop. My name is Jason Maida. It's great to be with all of you this evening. Thank you for taking time out of your busy schedules on a Wednesday summer evening to join us for your session. This is a quarterly workshop that we put on for the Alumni Association throughout the year. So there'll be 4 classes that we offer. We're so glad you got a chance to attend this one. The run time for tonight's session will take us up just about to the top of the hour. I know a lot of you that signed up for today's class kind of just get settled in after work and kind of plugging in. So we'll be pretty flexible and kind of we have a fluid conversation as we go through tonight's session. We are recording tonight as well too. So after tonight's class, this will be up on our YouTube channel. All of our presentation material will also share back out the slides with everybody who has signed up for tonight's class. So, our goal for tonight is just to help educate you and provide you resources on your path towards homeownership. We've been doing these classes with UCI for the last 7 years, and I can't tell you how many clients, we've had countless clients not only attend these classes, but graduate, so to speak, and then purchase their home and utilize our services to help them pursue their goals of home ownership. So we're glad you got a chance to join us tonight. Just so you know who we are, so I work for an organization called APM, or American Pacific Mortgage. We are a West Coast based organization, but we are a nationwide lender. I think primarily most of our class is going to be in the California markets, but we service all across the United States. Our team in particular focuses on homebuyer education and serving our community in homeownership. We do so through our 16 different partnerships we have with different university alumni associations all across the country. And of course, we have our partnership right here with UC Irvine. So 7 years ago, when we first started our partnership with UCI, we actually used to teach classes right there in the alumni hall upstairs and had 20 or 30 people attend class in person. But of course, our world has changed a little bit these days with everybody doing things on Zoom, and that's just a much more effective way of us being able to scale and be able to connect with more of you in the UCI community. So glad you got a chance to join us for tonight. Tonight's discussion, we're going to have a very open conversation. So we'd encourage you, if you have questions as we go through our content, just feel free to use the chat or Q&A function within Zoom. I'll answer those questions on air. And then we'll also carve out a little bit of time at the end of our session just to field any questions that our group might have. All right. Now, our talking points for this evening, we're going to spend some time talking a little bit about what's going on in the housing market, kind of what we're seeing right now with the summer buying season and kind of give you some insight there. Also want to spend some time talking a little bit about interest rate environment and what we're seeing here and maybe some of our projections on a go-forward basis. Also want to spend time talking a little bit about budgeting for home ownership. And I'm going to walk you through one of our calculators that's available to our buyers just to better understand comparing your budget on the path of renting versus what it looks like on the path of home ownership. We also want to talk a little bit about credit and preparing for home ownership from a credit perspective, give you a few takeaways to think about when it comes to getting your credit profile in line for home buying. Also talk about loan programs and what programs are available out to you, give you kind of a high level look at some of the underwriting guidelines for those programs, and also talk about savings for home ownership. That tends to be one of the bigger challenges for most home buyers is how do I, now that I may be settling into my career or just getting my financial house in order, how do I save for home ownership in a high cost of living market? We'll also talk about first-time buyer programs, look at the buying process, and then maybe spend a little bit of time looking at our consultative process. So again, this is a very interactive session. So if you do have questions, feel free to use the chat or Q&A function within Zoom. All right. So thanks again so much for joining us for our session tonight. Let's talk a little bit about buying. This is probably going to be one of the largest financial decisions you decide to make. So when we think about home ownership and comparing that versus where I'm at today from a rental perspective, there's some benefits I think to consider when it comes to home ownership. One is you do have the opportunity to create a budget for yourself that really is going to be based upon the purchase price that you have for yourself in that home. And, in a rental situation, you're kind of worried about what is my landlord going to increase my rent to on an annual basis, right? So we don't really have that fear, so to speak, in home ownership. So I'm more in a fixed rate program. Now, many of our clients that are choosing to buy in today's market are probably going to consider refinancing in a couple years when rates start to normalize, and we'll have that conversation around interest rates in that segment of our discussion tonight. But certainly those that are purchasing in today's market will consider refinancing maybe in a couple years down the road. Now, for most of us that are existing homeowners, this is probably our number one asset that we have that asset will grow over time, right? So if I purchase my home at a certain price, that home will appreciate. And as I pay down the balance on my home, the difference between what the market value is of my home and what my mortgage balance is, that's called home equity. And for most of us, like I said, that's our number one asset that we have. And it can be a huge game changer for many families across the country. It can be really an opportunity to really create generational wealth for a lot of families. And believe it or not, there's still some tax benefits. I know we're going to go through a little bit of tax changes out there, but there are still tax benefits that come into existence as a homeowner, potential tax deductibility of interest. And if I just choose to make maybe energy efficient upgrades to my home, reaping some benefits of tax deductibility with some of those improvements. All right. So that's kind of how we think a little bit about home ownership. Now, as we plan for home ownership, budgeting is probably going to be the first step that we have to take in that. And so in our class discussions, we like to look at like, what does it look like if I'm going to rent and continue to rent versus what it could look like on the buying side. So I'm going to screen share with you one of our helpful calculators that you can find on our website to kind of frame up for you what it could look like to compare renting versus buying. So I'm going to walk you through this calculator. Again, in case you missed it, we're going to share back all of our presentation slides. So you'll have those in your inbox tomorrow morning since you've signed up for today's class. And I would encourage you to walk through some of these exercises yourself. And so on this calculator, and I'll kind of just walk you through some of the important points here. We first of all plug in, what type of purchase price are we looking at? This scenario, we have a $750,000 home. We have a minimum down payment of 3%. We'll talk more about that in our product segment in just a bit. And then assuming that 3% down payment, we have an amount financed of $727,500. And then we have an assumed interest rate of 6.75. We have the term of my loan at 30-year fixed, and that's generally the typical term for most buyers in today's market. We have just the assumption of buying in the month of July, just as kind of a what if. And then we also have mortgage insurance cost or PMI. We're going to talk more about PMI tonight, but essentially PMI is when I put less than 20% down, I'm going to have mortgage insurance because I'm contributing less than 20% down to purchase my home. And then we have assumptions around homeowners insurance, the cost of property taxes. We left kind of a HOA open here, but let's say I'm purchasing a condominium or maybe a townhouse or a planned community, I might have an HOA expense there. And then from there, we would take a look at, what are my costs of renting? So we plugged in $3,500 in rent, assuming that rent will go up about 2% on the annualized basis. All right. So what this calculator kind of tells us back is that, essentially after 4 years, comparing renting for the next 4 years versus buying for the next 4 years, it's going to make sense, or my break-even point to buy is at the 4-year mark. Now, many buyers in today's market are probably going to sell their home every 5 to 7 years. So clearly that would probably make some sense for a homeowner. Now, as I move further into, that timeline, so if I'm looking at holding on this property for 10 years versus 4 years, I'm going to continue to see really a better return on my investment the longer I can hold, because ultimately, as my home appreciates in value, as I pay down my balance, I have just bigger opportunity in my home. So, at year 10 right now, my gain versus renting would be, I would basically have a $149,000 buying opportunity versus continuing to rent and perhaps paying somebody else's mortgage. Now, if I sold that home in, let's just go down to 5 years or a little bit less, 6 years, then it's a $50,000 opportunity. But I encourage clients, as they're considering home ownership, if you're paying $3,500 a month in rent, which is a substantial amount, that from my perspective doesn't necessarily equate to like $3,500 in mortgage, because we have to factor into our calculus, what's my appreciation rate going to look like for my home? Can I potentially reap some benefits from a tax deductibility perspective? And those are things we would encourage you to think about as you're considering home ownership. Now, as we're also considering home ownership, we got to understand, is this market right for me, right? And today, on July 30th, we sit in the middle of the summer buying season, which traditionally spring and summer are the busiest times of the year. That's where we see kind of more activity in buyers for a variety of different reasons. Most parts of the country, it's nicer weather, but if you're in Orange County, it's always nice, except for maybe in June, right? But more sellers are coming to the market with homes. And what we've seen over the last month or so is a lot more inventory on the market. So if you look in the greater Los Angeles area, days on market is 42 days on market. which is a lot higher than we've typically seen. If those of you that are already started some of your home searching on Redfin or Zillow, maybe you've identified a few homes that pique your interest. Some of those homes may have already seen some price cuts. So we are seeing more inventory on the market, which I do think is advantageous for a lot of buyers. It certainly hasn't something we've seen in the preceding 2 years. When we went into Memorial Day weekend, we already had kind of a backlog of inventory, and generally the Memorial Day weekend brings even more inventory to market. So, I think there's an encouraging sign from a supply perspective, and you can see we even with kind of increased supply in the LA market, we are seeing a little bit of an uptick in prices. Now, the median sales price, if you're in Orange County, say you're going to buy in the Irvine market, median sales price is probably looking a little bit different in Orange County, but I think the trends in market still remain about the same. So we're seeing a little bit more supply out there. And demand, believe it or not, is still pretty strong in today's market, even in this interest rate environment. Now, those of you who are kind of tracking what's going on in the economy, interest rates are obviously much higher than we've seen over the last, 3 years-ish. And we will eventually see interest rates trend lower. Currently average interest rate sits around 6.7 to 6.8%. We probably won't see any downward pressure on interest rates until we get into 2026, maybe even 2027. Why we're here currently at these level of interest rates is because the Federal Reserve has tried to combat inflation by ratcheting up the federal funds rate. In turn, we've seen mortgage interest rates lift higher, especially coming out of the pandemic of 2021, where interest rates bottomed out to 2.5%. The question I get often is, are we ever going to return to those days of 2.5% interest rates? And hopefully we don't ever, just from the perspective that, that means probably something catastrophic has happened. So we certainly don't want to return to that level. I think average interest rates are going to be in the high fours to low fives. That's typically what we see. Now, while interest rates are at elevated levels today, there still is buying opportunities for those that kind of like financially ready to enter the market. So even though maybe we're going to pay a higher premium of interest rate, I think the opportunity with inventory that's starting to sit a little bit longer, that's where a buyer can enter the market. Because as interest rates go lower, guess what happens? Competition will increase. If there's only a finite amount of inventory available, then we may see those prices kind of lift with kind of supply and the demand of new buyers entering the market in a much more favorable interest rate market. Now, interest rates today don't look a lot different than they did 20 years ago, but home prices, of course, were a fraction of what they are today. And, interest rates cycle, and I think that's what I want you to kind of take away from this 20-year look. Interest rates do cycle up and down based upon kind of the economic climate. Interest rates change by the minute in the trading day on Wall Street. So you'll see interest rates move up and down based upon what kind of economic news is coming in. And of course, in this geopolitical environment, things with tariffs on again, off again, kind of some global challenges that we have. Interest rates tend to be very volatile, and that's really kind of shown by what we've seen in the last 12 months. But I think, the takeaway from interest rates are, yes, we're going to be at a higher level for at least the balance of 25, and we'll probably see interest rates start to kind of come down a little bit in 2026, and then as we enter into 2027. Now, interest rates aren't the same for all clients that are pursuing homeownership. There's a variety of different characteristics that make up an interest rate, things like credit score and the eligibility of a specific loan program, the type of product that I'm going to look at, how much I decide to finance, what I want to put down for my down payment. And we haven't talked about this earlier, but you do have the option as a buyer to pay additional funds out of pocket in order to bring down my interest rate. However, those are upfront costs that a buyer has to pay. And I don't necessarily recommend doing that because, those costs aren't going to have a really good return on investment, because most clients buying in today's market, for example, are probably going to refinance in a couple years. So we don't want to put a lot of money out of pocket bringing down an interest rate with upfront costs if we're going to turn around and refinance in a couple of years. And then the last thing is loan term can also influence my interest rate. So the shorter my term is of my loan, potentially the lower my interest rate options will be. Now, we meet with all of our clients to build a comprehensive home buying plan. You'll hear me talk more about that tonight. But ultimately, we're going to kind of figure out, based upon your goals and objectives of home ownership, we're going to figure out what's the right plan for you as you pursue your goal of home purchasing. All right, we'll kind of figure out what the right design of a plan is. All right. Now, I want to kind of talk a little bit about credit. As we prepare for home ownership, understanding where we're at from a credit perspective and maybe some areas of opportunity in credit I think are really super important. Now, every loan program has a minimum credit score. So depending on what product we're going to target, there's a minimum credit score assigned, and you can see some of these programs listed here. We do have a product segment that we're going to go through in just a couple minutes, and I'll walk you through some of a high level look at the guidelines specific to those products. But that's kind of what the minimum scores look like. Now, when we think about applying for a mortgage, as a lender, we look at all three different credit agency scores. And those credit agencies are TransUnion, Equifax, and Experian. And each one of those agencies has a different score. So they have different models to their scores. And I'm going to walk you through the mortgage model in just a minute. But there's actually three different models to credit scoring. There's the credit card model, there's auto financing, and then there's the mortgage model. So of course, when you're obtaining home loan financing, we're going to look at the mortgage model. Now, many of you that are monitoring your credit through maybe your Wells Fargo bank account or American Express or maybe any one of those platforms, maybe Credit Karma, you're going to get a credit card score. So you may have a 760 score reported by Wells Fargo, but maybe your mortgage score is 750. The difference in those scores is just because the risk factors look a little bit different or the weightings in certain attributes of your credit score. And that's why we see a little bit of a difference there. Now, in lending, we always take the middle score of all three scores reported by the agencies. So if my highest score is 760, let's say my middle score is 740 and my lowest score is 720, we're always going to take the middle score, which in this scenario would be 740 for qualifying purposes. Now, if my partner is also going to apply with me as a co-applicant, and let's say their scores are 720, 700, and 680, well, their lowest middle score is 700 versus my 740. So in lending, we would have to use that 700 to determine product eligibility, interest rate, maybe even the cost of mortgage insurance. All right, so we're always essentially going to take the lowest middle score of all borrowers. Now, when we look at past challenges on our credit, let's say we had a delinquent student loan payment in September of 24, that impact to my credit score is going to be in the most recent 12 to 24 months from the date of the event. Okay. So if I had that late payment in September of 24, I'm still inside of 12 months. So probably feeling a little bit of the effects in my credit score. But as I move further away from the event, I'll probably start to see some organic improvement in my credit score. Now, that late payment will remain on my score or on my report for longer. In fact, it'll be there for 7 years, as you can see displayed by this matrix. So this is how long a negative item essentially will stay on your credit report. But generally speaking, the kind of active impact to your credit score will be in the most recent 12 to 24 months. Now, this is the mortgage credit score model, okay? And I share this with our classes because I think as you look at your own personal credit profile, you may look at this and say, hey, that's my area of opportunity for myself in improving my credit score. Maybe that's to go from a 740 to a 780, or maybe from a 680 to a 720. But those little upticks in credit score can be the difference in an interest rate or a mortgage insurance or general product eligibility for you as a buyer. So let's kind of take a look at that model, and we'll start here at length of credit. That essentially is 15% of the weighting. It's basically how long have I had my credit profile open. So the longer my credit profile has been established with the agencies, the higher my credit score is going to be. 20% is going to be how much new credit am I trying to activate? So am I opening up new accounts in the last 12 months or 24 months? Do I have new inquiries on my credit, especially in the last 12 months? If I have a hard inquiry on my credit, that's going to have an impact to my credit score. Now, there are rules in place for credit scoring which say this: if I'm going to apply for auto financing, I have a 30-day window of time to apply with as many auto financing lenders as I want. And it's the equivalent of one credit inquiry hit to my score. That same rule applies to mortgage. So I still have that 30-day window of time to shop around with as many lenders as I want. Now, we do things a little bit different here with our team because primarily we work with first-time buyers, and that buying cycle can be a month, it can be 3 years, right? So we always start with a soft credit check for our clients because we don't want to negatively impact their score, but we want to also provide them some resources and teachings on what they can do in home buying. So that soft credit check will allow us to be able to assist them, but not impacting their score. Now, next component is amount owed. So we're looking at revolving credit. We're looking at the credit balances that I have outstanding versus my credit limits. And so let's use an example of a $10,000 limit. If I'm at $6,000 in balances, I'm currently at 60% utilization of credit. So we're a little bit on the high side. So that's probably pulling it back on our score a little bit. So our first level of improvement would be to get that to 50% or less utilization. So 5,000 or less. Then I want to get to 3,000 or less in balances, or 30%. And then optimal level would be to get to $1,000 or less in outstanding balances. We understand this time of the year, it's summer buying, right? Maybe booking a trip or something like that, or I'm out and about spending a little bit more money. We understand credit balances can rise a little bit. So as you're preparing for home ownership, there's ways that we can try to get our credit balances as low as possible in order to optimize credit score. And one of those ways is to look a little bit closer at one of your credit card statements. Now, there's two important dates there. There's the billing cycle date, which essentially is the date when the credit card issuer closes out all your activity. And there's the due date for when your payments actually due. So my tip for our class tonight is that you can pay down the balance on that credit card or pay it off before the end of that billing cycle date. You're going to have a much lower balance reported out to the agencies, which will show a much lower utilization, therefore improving your credit score. And so especially as you're getting ready to apply for financing, that's a really easy opportunity to help improve your credit score. Last component is payment history. That's essentially how have I paid my bills, right? Now, you heard me mention earlier, if I've had a late payment, it's going to affect me in the most recent 12 to 24 months. The more severe my delinquency is, so if I had like a 90-day delinquency, bigger impact I'm going to have to my credit score. All right. So, as we meet with clients to build their own home buying plan, credit's one of the things that we're going to kind of go through a little bit just because we want to discover some opportunities for our clients to help take that credit score maybe to the next level to help improve ultimately their financing and really financing options and overall loan structure. Now, one of the things we look at on credit scores or credit reports is going to inevitably pop up as student loans. And I like to cover student loans in our classes because I want to take the fear factor out of student loans when you consider home ownership, because oftentimes clients will reach out to me and say, hey, Jason, I got this much in student loans, and so I'm really worried that I can even qualify for financing. So I want to give you some kind of clarity on how we view student loans. So if you're in an active repayment on your student loan, so let's say you're in income-based repayment right now, we can take that income-based repayment minimum payment for your qualifying. So if I have $75,000 in student loan debt and I'm paying $250 per month, that payment can be used to qualify you for your mortgage. Now, if you're in forbearance or if you're in deferment, or maybe you have like a public forgiveness program, there's probably no payments that are activated right now. So by default, if you're going to apply for home financing today, if I have that same $75,000 in debt, and let's say I'm going to do an FHA loan, which we'll talk about here in just a minute, I have to use 0.5% of those balances, or $375 per month, as an estimated kind of what if payment. If I'm going to apply for a Fannie Mae conventional loan, we have to use 1% of the balances if we're not in active repayment. So that would be what, $750 per month. So there's ways that we can help navigate the student loan waters. And I know a lot of student loans are coming back online for repayment right now. So those are one of the things we kind of talk through with clients as we're kind of determining their eligibility, because ultimately, when we take a look at home buying options for clients, we have to look at expenses or obligations versus their income. And so those student loans are kind of like naturally going to come up in our course of our conversation. All right, we're going to talk about loan programs now. Before I get too far along, I want to just take a quick pause. Any questions from the audience so far about any of the topics we've covered up to this point? And again, you can use the Q&A or the chat function in Zoom, and of course, I'll get those questions answered for you on air. All right. I think we're good. Okay, so let's keep the conversation going. Let's talk a little bit about loan programs. And so we like to kind of spotlight some of these programs to give you kind of a high level look at what these kind of guidelines, if you will, look like for each one of these programs. So the first one we'll kind of dive into is the conventional home loan. That's also kind of known as a Fannie Mae or Freddie Mac loan. For a first-time buyer, it does have a minimum down payment of 3%, minimum credit score of 620, up to a maximum loan amount of 802,650. However, if you're in a high cost of living area, and guess what? No surprise to anybody here, Irvine's a high cost of living market. So if you're going to buy in Irvine, for example, Fannie Mae and Freddie Mac will go up to a high balance loan limit, which is basically $1,209,000. However, the minimum down payment jumps from 3% to 5% anytime we exceed that conforming loan limit of 802,650. Okay, so that's what that number looks like. Now, every year, Fannie Mae and Freddie Mac update the conforming loan limit based upon kind of the cost of living across the market. So right around September, October, we'll see a new published conforming loan limit, and then we'll adjust accordingly for the upcoming year. Next product is the FHA home loan. That's a federally insured loan. FHA stands for the Federal Housing Administration. Again, government insured loan, minimum down payment, 3.5%. Minimum credit score of 580. The loan amount that we can offer with FHA varies based upon the county that you want to purchase in. So that will vary based upon across the country. FHA also does have a high balance designation. So again, just to use Orange County or Irvine as an example, you can also go up to that $1.2 million figure. Now, the difference with FHA is that down payment remains consistent at 3.5% regardless of the maximum loan amount. Now, I want to kind of put together both the FHA and USDA products in a conversation really quick, because just 2 months ago, unfortunately, there were some changes to both of these products because these are both government insured loans. And so part of some of the changes were the status, if you will, the residency status for eligible borrowers for that. So unfortunately, those products do not allow non-permanent residents to access these programs. Conventional loans still do, but unfortunately not with FHA and USDA. So you have to be a permanent resident to access those programs. And so I bring those together because they are both government insured, but USDA is a rule-based product that allows buyers to purchase in more rural areas. There's two kind of components to USDA. There's a maximum household income, and then it has to reside in a rural or dense or lesser populated area, I should say. The USDA product also has a maximum loan amount based upon the area that we're going to purchase in. Jumbo loans aren't typical for our first-time buyers, but I like to cover in our classes. It just basically allows a buyer to purchase with a little bit more funding power than we would have within a conventional loan, but it also comes with it a higher down payment requirement, usually a higher credit score requirement, usually higher asset requirements. Now, one of the things I didn't have showcased on our product section is different products like a physician's loan. So if we're in residency or we're just getting ready to start a practice, we have a physician's loan that gives a little bit more ease, if you will, when it comes to student loans and how we factor those into the qualifying like we just looked at. So that's an option to look at too. Usually the physician's loan has a minimum down payment of 3%. So if you're interested in that product, we can have a conversation around that either in the latter part of today's session, or we can certainly talk offline about some options there. The last product I want to spotlight here is our VA home loan. That's for veterans that have eligibility under the VA home loan. It is a zero down payment option for the veteran, lower credit score requirements of 620, and no real max loan amount for the veteran. This product allows the veteran to have an access point to home ownership, so it creates a lot more flexibility when it comes to the underwriting guidelines. All right, so we're going to kind of dovetail off of the products section because I want to kind of dive a little bit deeper into a topic that we discussed briefly in our rent versus buying calculator, and that is around mortgage insurance. So there's two forms of mortgage insurance. There's PMI, which is also known as private mortgage insurance, and there's MIP, or mortgage insurance premium, that comes along with the FHA product. So I want to dive a little bit deeper and educate you on what mortgage insurance is all about. And mortgage insurance is essentially insurance that covers a lender against default by the buyer. So if there's many challenges by the buyer, then the lender would be protected against that default. So if we look at a conventional home loan, mortgage insurance premium is based upon your down payment, your credit score, and how much you finance. So the higher my credit score is, the higher my down payment is, the lesser cost I'm going to realize on the cost of that premium. Now, on a conventional loan, once I reach 2 years in my original loan and I achieve 20 to 22% equity, I can then apply to have my mortgage insurance canceled on my loan. So, that's a really kind of a popular benefit of the conventional PMI. Now, if we were to look at a premium scenario of a conventional loan, if I finance, let's say $700,000 and I was putting down 3% and I had a 740 credit score, my premium's $209 per month. So if some of you have already started some of your searches on Redfin or Zillow, maybe use some of those calculators, those premiums tend to be a bit inflated on those sites. They're not really calibrated to what I just shared with you. So, that's kind of a good little, look at what mortgage insurance looks like, because there's a big misconception that mortgage insurance is a super massive number when in reality it's not as bad, especially for our higher credit score customers. Now, FHA works a little bit differently. So FHA has a couple components to it. So there's monthly mortgage insurance. There's also upfront mortgage insurance. So the monthly mortgage insurance is calculated at 0.55% of my loan amount, and upfront mortgage insurance adds at 1.75% of my loan amount. So that gets factored in my total amount financed. Now, one of the things different with FHA is that it does not have a cancellation option. So generally, FHA is going to be kind of a bridge for our clients. I don't look at it as the long-term loan for our clients. It allows us to get access to home ownership because maybe we need to leverage the FHA product because I have maybe a lower credit score or maybe some overall credit challenges, different things like that, or maybe my expenses are a little bit high. But FHA is a great entry point for our clients that maybe just aren't qualified today under the conventional loan. Now, if we look at the premium cost, we finance that same $700,000. We have the upfront mortgage insurance, but we also have the MIP, which you can see here noted. So it's going to be rather, or more expensive, I should say, than a conventional loan. But to my point earlier, it is going to have a lot more flexibility when it comes to guidelines. So if I had a 60-day late payment on a student loan just 12 months ago, more than likely it's going to be very tough to get qualified in conventional, not only because my credit score has been impacted, but I have a pretty major late payment in the last 12 months. FHA would be a little bit more lenient and flexible with that. So that would probably be the direction that we would have to go. Ultimately, as we meet with our clients, we're going to figure out based upon your overall qualifying, what's the optimal path to move forward in looking at different options for you around home ownership. Now, I noticed we have a few students, if you will, arrive late to class, and that's totally fine because we're actually recording tonight's class. So in case you missed, the first half of our discussion, we got that all recorded. And just to remind everyone, that'll be up on our YouTube channel tomorrow. And I'm also going to send back all the slides from today's show or discussion out to you tomorrow as well, too. But thank you for joining regardless. Let's talk a little bit about employment because, employment is a conversation that comes up in a lot of my conversations with clients preparing for home ownership. And so, when we look at employment, there are rules to the guidelines, if you will, in employment. Now, before we dive into that, I just want to give you kind of a little bit of a leave behind in terms of the documents that we generally will ask for as you prepare for home ownership. So these are the general documents over the last 2 years that we'll generally want to gather as we kind of validate some of the information from your application. Now, in as it relates to employment, there is a bit of a misconception out there about how long you have to be on your job. Now, when we qualify clients for home financing, we have to basically put together a 2-year history of work and/or education. And I think that's really important because you don't necessarily have to be on your job for 2 years. If I just graduated from UCI in the fall and I just started my new job, even though I've been on my job for 6 months, say, I can still qualify for a mortgage as we piece together education and my current work history. So, I think that's encouraging for some of us in tonight's class because there is opportunities to buy sooner than having to wait for being on a job at a certain amount of time. Here's an example too that might be relevant for our class. We have a client today that's actually getting the keys to their home next week. They are moving from Idaho to Norco, and in their move, they're not going to start their job until next week, but we're able to pre-approve them for their home financing with a offer letter because the guidelines allow you to do that. So as long as we can verify that new job, a client can purchase a home with an executed offer letter. Of course, it has to be an unconditional offer letter, but that is ways that we can structure financing. So we ultimately have to just build a 2-year overall work and/or education history. Now, there's other rules and guidelines, like, for example, for self-employed clients, we do have to show 2 years of tax filing. So that's a little bit different. If I have 2 jobs, so if I have 2 sources of income and I want to count both sources, in that case, I have to show that I've been on both jobs simultaneously for 2 years because we just got to show that that buyer has consistency with both sources of income. Now, if I have a job where I work 40 hours a week, and then I also, let's say, drive for Uber or Lyft or have just a secondary job on the side, that also is a scenario where I have to show that I've been working at both jobs simultaneously for the last 2 years. Now, if some of us in class have variable income sources, so let's say I have a base salary, but I also earn income in either overtime or maybe it's in bonuses or commissions. In that case, if I want to count the variable sources of income into my employment for qualifying for my mortgage, that's a scenario where I have to show that I've been on my job for 2 years because what an underwriter does is they average out the last 2 years of those variable sources. Last thing I want to kind of touch on is just other sources of income. So let's say, for example, my partner contributes to my income. Maybe they help with the rent or they contribute for certain household bills. Unless my partner is going to be part of my application, that income is not recognized in the qualifying. Also, if I have room rents or any other type of side income sources, those generally can't be added into the equation unless they can be fully documented. Room rents are a little bit challenging because we have to buy an investment property to consider those for future use. All right, so hopefully that kind of maybe dispels some of the myths around employment and kind of verifying income. Now, we also take a look at your expenses versus your income. And that's called debt to income ratio. Now, our number one, thing that we're looking at in designing homeownership is affordability for our clients, because that's really important. Debt to income ratio for us is just giving us a guideline for qualifying. And that qualifying looks at your pre-tax income versus your outgoing expenses, which will also factor in the new housing expense. So for example, if we look at the housing expense, that's going to include the principal and interest of my loan, the estimated property taxes, my homeowner's insurance, and maybe mortgage insurance if I'm putting, say, less than 20% down. Or if I'm buying a condo in Irvine and I'm paying $600 a month in HOA fees, that would also be factored into the housing budget. Now, we also want to look at any other debts that appear on your credit report, personal loans, credit cards, auto financing, things of that nature. Now, the guidelines don't want those expenses to exceed more than 45 to 50% on the high end of your pre-tax income. And let's face it, we don't take home what we gross in wages because we have 401ks and state and federal taxes. So it's really important that as we think about home ownership, that we're designing an affordable budget, even though the debt to income ratio can really have you afford or qualify, I should say, for a much higher payment. So if we look at a calculation of debt to income ratio, I kind of just described it over here, but here's someone that has a housing budget of $2,500 with other debts of $500 and they're making $8,500 a month. So this debt to income ratio tells us that 35.3% of their pre-tax income is going to be consumed by those obligations, including the forecasted mortgage payment. Now, the question I get often is, where should I be? Even though the debt to income ratio goes to 45 or 50%, what's the optimal level? I would say for most buyers, excellent would probably be 36% or less. So essentially 36% of my pre-tax income goes out to my expenses. But it does vary based upon, really where I'm at financially and really kind of the housing market I'm going to buy in. Let's face it, if I'm in a Orange County, LA County, or a Bay Area, Northern California market, the cost of living is higher, so I might have a higher debt to income ratio. I met with a client earlier today and they wanted to be at 19% debt to income ratio. So everybody has a varying tolerance level. So looks like I have a hand raised. So Tyrone, if you have a question, feel free to drop it in the chat or Q&A, and I'll definitely answer that for you, or either way, or we can field that question afterwards. But that's what debt to income ratio looks like. And again, that's just a metric for us in determining qualifying in home financing. Last topic we want to talk about before we dive into the process of home buying is to talk really around savings and resources for home ownership. Now, I wanted to pass along some of the acceptable sources of assets that you can use for home ownership. So, of course, checking in savings can be used in your savings for home ownership, but cash is not acceptable. So we have to paper trail all assets used in a home purchase. In fact, we have to make sure assets are seasoned for 60 days. Now, you can also use 401ks, 403bs. Those are all allowed. I would encourage you, though, talk to your tax or financial advisor before you access those assets so we don't create any tax liability for yourself. And the question I get a lot is gift funds. So gift funds are where family members are contributing towards your home purchase. Those can be absolutely allowed. There is no seasoning requirements for those gift funds, and there's no limitation. A family member can gift as much as they want to, but there is a documentation process for that. The donor has to complete a gift letter, and we have to use some other different verification sources. Now, when we look at savings for homeownership, for most clients that I work with throughout the country, that's probably one of the biggest challenges next to credit. And so in our classes, I like to walk our class through a really simple savings plan around homeownership. And so as we meet with our clients, we design a home buying budget, right? What looks like on a monthly basis. And we compare that with what they're doing from a rent perspective. Now, if my client is capable of paying $3,500 a month in mortgage, but it just really isn't there from a savings perspective, my plan for our client would look something like this. So on the first of the month, when we're paying our $2,000 rent payment, what we want to do is create a discipline for ourselves that rather than just paying that $2,000 a month and kind of going on our way, get in the habit of paying $3,500 in total outgo. But here's what we do. We pay our $2,000 to our landlord and we create that discipline of that additional $1,500 that I can afford to pay in a mortgage. We want to transfer that to our savings account on a monthly basis. And it's a very simple approach, but after 6 months, we have $9,000 that grows in our savings account. We have, 18,000 by the end of the year. Not to mention, if it's a high yield interest account, you're going to get some interest on top of that. And that's a great way not only to create more savings for yourself, but create that discipline and that habit of making that payment. So let's face it, when I jump from $2,000 in rent to $3,500 in mortgage, doesn't feel like such a big leap because I've been doing it through my savings plan. So that's just a really easy way of building up savings. And, we've seen that work really effectively for our buyers that are preparing for home ownership. Now, there's other resources available to you. And since most of our class is based out of California, I think it would be appropriate to talk about CalHFA, which we're proud to be the #1 partner of the California Housing Finance Agency in California. And so what CalHFA does, it supports low to moderate income households. CalHFA has been around since the 70s. In fact, in September, CalHFA is going to be celebrating their 50th anniversary of supporting low to moderate income families in communities across California, not just in single family or one unit homes, but also multiple housing that they do across the state. So in being a partner with CalHFA, we like to kind of spotlight some of these products because a lot of people aren't aware that there's resources out there. So the first one is the MyHome Assistance Program, which, as we learned about products earlier, provides 3% on your conventional loan for the minimum down payment, 3.5% for an FHA loan. Essentially what this is, it's a separate loan that we create for you in your financing for whatever amount at a 1% simple interest rate loan. There's no monthly payments required, paid back to the state on that. It's not returned to the state until you either sell your home or if you refinance in the future. So it's completely deferred. And it can be also coupled with other assistance programs under CalHFA, like the MyAccess program that provides 2.5% of your loan amount in assistance. That's also at a 1% interest rate. So it can give you some additional resources to reduce down your out-of-pocket. And kind of an interchangeable product would be this ZIP program. So we'd have to look at either one of these products, but MyAccess or ZIP can be one of those products that's interchangeable to help reduce down your out-of-pocket. ZIP essentially is 2% of your loan amount, but it's 0% interest. Now, when we add one of these products into your first-time buyer plan, it can elevate your mortgage interest rate. So we want to use this as kind of a plan B option, but certainly the first option here at CalHFA MyHome provides a really low interest rate on your first mortgage. Plus, it does provide resources to cover that minimum down payment. Now, in addition to CalHFA, we have other programs internally like the Pathway DPA program that can help with assistance on FHA loans. In California, we have the Golden State Finance Authority program. That's going to be probably an alternative to CalHFA if a buyer doesn't qualify for CalHFA. And then Fannie Mae and Freddie Mac also offers assistance for low income, which is someone that makes less than 80% of the median income, or we call it very low income, which is less than 60% of the median income. So CalHFA has a lot of great tools out there. You may have heard about CalHFA as we spotlighted the Dream for All program, which is a shared appreciation program. Unfortunately, it's not currently online for new applicants, but we may say that come back online in the future, and we'll certainly have updates on our socials as we get more information on Dream for All. I wanted to just, as a kind of a takeaway for you in tonight's class, just give you some quick looks at what CalHFA can do for you and give you the guidelines, because it's a very inclusive program. If you purchased a home for, say, $700,000 and you put 3% down and you were looking at the closing cost of your home purchase, traditionally you would probably need to save up about $35,000 to $42,000 is what that scenario would look like. But with CalHFA and we kind of substitute in that MyHome Assistance, then we can get $21,000 to cover that down payment and maybe shrink in half that amount out of pocket. And if we needed more resources, we could also add in maybe MyHome or MyAccess. So, the reality is for someone purchasing a home at that level, if they're eligible, they have eligible assistance up to almost $38,000 in resources. So I think that's really encouraging news for our buyers, especially in a high cost of living market in California. Affordability is a challenge. And so really, if we can leverage these resources, that can hopefully make homeownership much more of a near-term goal for you. Now, and these products are really complementing for the minimum contribution for home purchase, but you can add as much resources on top of those assistance programs as you would like. So there's no restrictions on how much assets you have on hand. Now, the eligibility requirements look like this. So you get on a FHA loan, it's a minimum score of 640. Conventional loan, it's a 680. We've learned a little bit about debt to income ratio tonight, so we can go as high as 50%. And a first-time buyer is someone that hasn't owned in the last 3 years. Now, I mentioned to you really quickly about the Dream for All program. That had a stipulation of being a first generational buyer, which is someone that hasn't owned in the last 7 years, nor has their parents owned. But this doesn't have that stipulation on these programs. You only have to be a first-time buyer, which is someone that hasn't owned in the last 3 years. This does have to be a one-unit property, so single-family home, condo, townhouse, even a manufactured home can be eligible for these types of programs. Now, there are income limits for the program. And the nice thing about these income limits, in fact, they just went up a couple weeks ago, but they are based upon 150% of the median income for the market that you want to buy in. So we kind of spotlighted those in this page here. If you're not in one of these counties and you're interested in the product, we'll go ahead and drop in the chat the income limits link to the CalHFA page, and you can kind of check out a county that maybe you're interested in. All right, so that was our kind of first-time buyer assistance segment, and hopefully you found that to be helpful for you. We'd love to be able to help educate you more on maybe what products can benefit you there. Again, as being the leading provider of these programs, we really are experts in getting you to the finish line with the utilization of these products. One thing I will just share with you before we talk about process. One of the misconceptions in the market is that if you use an assistance program as a first-time buyer, it's going to slow down your process. And so our assistance programs work just as quickly as just traditional financing. So don't allow that kind of misconception to hold you back from looking at your resources as a first-time buyer. Now, there are some other community programs that we don't have time to talk about tonight, but for those of you that may be considering LA County, one of the kind of cool programs out there is called Green Line that's available for LA County purchases. There are a little bit lower income requirements on that product. You can't make more than 120% of the median income. But if you're thinking about LA County, that's certainly something we can talk about as well too. All right, let's talk a little bit about the buying process. And after we leave tonight's class, I like to give our attendees kind of like what happens from here. Because if you're considering home ownership, I kind of want you to know like what's the next step or action items look like for me. Now, I'd love to be able to get connected with each of you for a consultation to design your home buying plan for you. Now, whether you're going to buy next month, the end of this year, or 3 years from now, I meet with clients all across the country in different cycles of buying times. So you don't have to feel pressure to buy, but I think understanding what your options look like and a plan for home ownership is a really important next step here after leaving tonight's class. Now, as part of that consultation, we put together a plan, but we also get you in a position where you're pre-approved for your financing. Now, while a pre-approval is generally good for 60 days, that can be always extended at any time. So we've had buyers that have been shopping for homes for 2 or 3 years, so you don't have to feel the pressure of finding a home anytime soon, but at least you know what your options look like. That pre-approval can be tailored or customized as you begin your search. And that really moves us to step 2 in the process, which is the house hunting phase. That's for most of us the fun part. As you heard in my housing market update, like inventory is starting to improve. So we're seeing more supply out there or choices for buyers. We'd encourage you to get connected with a local realtor that really understands that market and really has a reputation of representing buyers, especially first-time buyers, properly. We do have a trusted network of preferred realtors in your market that we can introduce you to if you do need a resource. But a realtor is a really important partner in the process. They should be able to help find the right property, identify that community being a match for you, and of course, negotiating the best offer possible for you. Now, if that offer gets accepted whenever you identify that right property, that will move you to step 3 in our workflow here. That means you have a ratified agreement with the seller. That's also called entering escrow in California and most parts of the country. When that happens, now it kind of starts what we call the escrow process. So when we go from accepted offer to when we get the keys to our house, that's called the home closing. Traditionally, it takes about 30 days in most markets. Now, that needle has kind of moved back to about 20 days is kind of the norm now. In our process, we can move as fast as 14 days. That's called our quick close program. So we can move pretty fast, but usually it's about 30 days from accepted offer to getting the keys to your house. Now, when that offer gets accepted, you're going to get a call from us saying, congratulations. Hey, you got your offer accepted. Let's talk a little bit about what the next steps look like in lending, which includes getting your follow-up consultation scheduled so we can review all the aspects of your financing payment, interest rate, what your out-of-pocket expense looks like. But you'll also have some other items to do. There'll be disclosures from your realtor as well as disclosures from your lending side that you'll be signing. And within 3 days, you'll generally have to make what we call as an earnest money deposit. Now, that deposit in most markets is anywhere between 1 to 2% of your total purchase price. That will count towards your total out-of-pocket expense. Okay. So that's a question I get a lot is if you make a $10,000 deposit, it will count towards the remaining amount that you have to make out of pocket. Now, in most contracts, especially in California, there's what we call as the contingency period, which is a timeline for you to do your investigative work on the house, which would include getting inspections done, getting your loan approved, also getting your appraisal completed. So we want to make sure we check all of those boxes to make sure this is really a good sound investment for you. And what's important about the contingency period is it protects that deposit that while you go through that research, you're not risking losing your deposit while you kind of do your due diligence. Now, as we move through the escrow time period, step 4 brings us to the administrative functions of the loan. We verify your employment, we verify your assets. We really recommend while you're under a contract with your seller, we're not making any financial purchases, try not to move money around, kind of keep things pretty simple from a financial perspective. And then as we round out step 4, that leads us into the underwriting phase where an underwriter verifies all your information, your application, and ultimately issues a loan approval for you. That almost takes us to 2 to 3 weeks into your home buying process. Could be shorter depending on the timeline of your transaction. But at that phase in the process, we probably had your interest rate locked in by then because as I mentioned earlier, interest rates move by the minute. So we want to secure the lowest interest rate for you. And at step 5, we're going to issue to you a final closing disclosure. That gives you a 3-day cooling off period before we get to the very final milestone. That's called closing your loan. And at that phase, you're going to be signing final loan documents with the public notary. You'll also wire in your final funds for your home purchase. And that really is the only time that you have to be in person for your home transaction, other than, of course, going out and seeing your property in person. Now, once all those monies get reconciled, documents get recorded with the county recorder's office. They record a grant deed to transfer ownership to you, as well as the deed for the loan. After those items get confirmed as recording, then I get a chance to make my favorite call of the day, and that's to say, hey, congratulations. You did it. You're now a new homeowner, and it's the best part of our day. It's a chance to celebrate because obviously it's a huge financial accomplishment. It is truly the American dream for people to obtain home ownership. And what's cool about it, it starts quite often in a classroom environment like this. And so, we're excited to celebrate with our clients. Now, our relationships with our clients don't stop there because as part of our aftercare, we want to make sure we monitor the interest rate environment. So if it ever makes sense to refinance, we're going to make sure that you're top of mind for that. And we have different tools to help support you when that time is right. And of course, our financial lives change for our clients all the time. So we want to make sure we're always there as a resource. Well, we got a few minutes left in class. I just want to kind of let you know about how, if you're considering homeownership, how you can get started in the process if you so choose to. We have a very simple get started process. It's 3 steps. It's an online application. We do a soft credit check, as I mentioned earlier, but that does not impact your score. You then upload documents, and then you'll schedule a consultation with us at your convenience. It's a 30-minute session I do with every client just to help design a home buying plan for you. And like I said, it's something where you're not expected to run out and buy a house right away. This is just a plan for home ownership. Quite often I'm meeting with clients that have attended the classes that want to put together a year or 2-year strategic plan. And we love doing that because you're well ahead of the curve to prepare yourself for home ownership. This is kind of what a consultation looks like. It is a free service. It's a non-obligation type of session that we do with you, but we want to understand, like, where do you want to buy? What's your budget look like? What does maybe some credit opportunities look like for you? Is there a good match with first-time buyer programs? Things that are going to be really important for you to make a really great financial decision. Now, I just want to kind of point out just one of our resources for you. We really leverage technology in our process, but it doesn't replace the human touch. So we really try to make sure that we have a high contact with our clients, whether that's text, email, phones, whatever mode of communication our clients want. We want to make sure we're there to serve. But our mobile is a great tool to start the process. You can chart your course of following your loan through the process, as well as use the calculation function in mobile. As we wrap up, I didn't get a chance to spotlight the discount that we pass along to our UCI alum. So we discount our services by $750 for our UCI alum. Of course, as you're experiencing now, you get access to our free classes that we teach, quarterly classes throughout the year. So we want to make sure we pass on those value benefits to you. Now, we also have 15 other partnerships all across the country. So if you've enjoyed tonight's class, we'd encourage you to share some of this content with friends, family, and coworkers. I think we have at least probably 35 plus classes left on the calendar for this year. So, we'll have another class for UCI. So feel free to pass along this information to those that might enjoy some of this information. Here's all my contact information. So if you do have questions, we're going to open it up for Q&A in a second, but if you want to kind of follow up with me after class or just kind of want to see, or kind of go through a scenario with me, feel free to reach out to me on text, email, or you can just schedule a consultation with me, whichever is easier for you. And as we wrap up, I just want to remind you again, this class is going to be recorded, going to be up on our YouTube channel. We'll share back all the slides with you. And as you're kind of checking out our YouTube channel and some of our socials, we love what our community says about us. We really are passionate about serving in homeownership, and you can kind of see those testimonials, whether on Google or Yelp or on Reddit, just people sharing how we serve them in homeownership, because we understand this is a major financial decision for yourselves. And so we really take serious how we kind of be a partner for you on that journey to achieve your financial goal. All right, well, that takes us to the end of class. We have a few minutes before the top of the hour. I know we've had a few join us late, and you guys are sticking around, so I really appreciate you guys participating in today's class. So I'm gonna stand by for some questions. I already got one in, so let's go ahead and do that, and then we'll get wrapped up. So in general, when do most UCI graduates contact you to buy a home? So it really just depends. It depends on kind of where they're at in, kind of their financial lives and where they want to be. I've had some, students existing in school right now walk through home buying scenarios because they have a prospective job, they know what they're going to make, and they know where they want to live. And so some people are ready to go at it as soon as they get out of school. Others, maybe you're 2 or 3 years out of college and now want to kind of, they're kind of settled in their careers, so they want to kind of start pursuing things. Wherever you're at in your financial lives, we want to make sure that you understand kind of what home ownership looks like for you, if that's one of your goals. For a first-time buyer, first-generation home buyers, do you recommend buying a house or a condo first in Orange County? It's really hard to say. I mean, I think it's going to come back probably to affordability and lifestyle because, condo living looks different than, single family home living. So I think it's really kind of what your draw is. I will say in my high cost of living markets that I support home ownership. Condos and townhouses are kind of some of the alternative. But, that being said, those have HOA expenses that can be a little bit more costly, right? So we got to have that, within the calculation. And so we'll help you through that as you're kind of figuring out homeownership and where to buy. But I wouldn't say one is better than the other. I think it's going to come down to affordability and what your budget looks like. All right. Thank you for those questions. That's awesome. Um, any other questions from the group? We're all hanging in there. Anybody have a lingering question? I think maybe somebody has something. Okay, I think we're good. All right. Well, again, we'll have all this material out to you tomorrow. I appreciate you spending your Wednesday evening with us. Hopefully you had one or two takeaways for you to help you on your journey towards home ownership. I hopefully get a chance to connect with each of you at some point in time. I wish you guys all a wonderful rest of your week, and I look forward to seeing you soon. Have a good night.